Gold's only up about 12 bucks right now. It's just below 4,500. It was just above, kind of trading above and below. Silver's back above $74. Look, this was a major breakout. We did hit $89 like a week ago. So we had a big pullback. Again, the catalysts for all the sell-offs are rising bond yields and rising oil prices. Two bullish things for gold and silver. Gold isn't working as a hedge anymore, right? Just because it's pulling back. That's what these pullbacks are designed to do. They shake the conviction of the weak hands. People who really don't understand what is going on. You can't get into dollars because the real problem with bonds is that they're IOU dollars. We can't survive that. There would be massive defaults. There would be a financial crisis that would make the 2008 crisis look like a Sunday school picnic, which is why this time inflation is going to run out of control. One of the things that Trump said, he does not want lower home prices because he wants the older people who already own homes to be able to feel rich. He doesn't give a shit about the young people, young families who are struggling to buy overpriced homes. He's buying dollars. They're selling gold. Gold's back below 4,500. Silver's down around $74 because they're reacting to these nominal stories about rates, missing the bigger picture that real rates are imploding because inflation is skyrocketing. And one of the reasons that you have all of this complacency now is the war. See, a lot of traders think that we don't have to worry about rising bond yields. We don't have to worry about rising energy prices or rising, food prices because it's all the war. And all we have to do is end this war and prices are going to crash, bond yields are going to crash, and therefore people are not worried. They're completely wrong. It's not the war. The war may have been the catalyst for a breakout that was going to happen anyway. And if it wasn't the war, it would have been something else. But bond yields were going to rise. Inflation was going to rise with or without the war. And if the war ends, bond prices aren't going to stop rising. Commodity prices, oil prices are not going to stop rising. They're going to keep rising, which is another reason why Trump may not end the war. Because if he does end the war and then we don't get a crash in oil prices and bond yields, then what is he going to do? Then he's out of tricks. One reason to keep the war going indefinitely is because you always have something to blame the problems on. And you can claim the problems are transitory, so we don't really have to worry. We don't have to worry about $120 oil or $150 oil because as soon as we win this war, it's going down to 50, right?
Markets keep cheering headlines while the underlying cost structure keeps getting worse. Peter Schiff notes the larger disconnect is not war itself, but investors treating geopolitical noise like the root cause instead of structural inflation pressure already embedded in debt, energy, and credit markets. If bond yields and commodities rise together, the temporary shock narrative weakens fast. For savers, that means false calm can become purchasing power erosion long before portfolios react. Next, Peter Schiff reveals why inflation may outlive the excuse built around war.
That's what we could say. We don't have to worry about 6 or 7% bond yields. We don't have to worry about an 8 or a 9 or a 10% mortgage because that's all going to change as soon as we win the war, right? They can keep on saying that all we have to do is win this war and end this war, which we supposedly can do whatever we want. And that is creating, I think, for now, this sense of complacency. But at some point, as yields keep rising, as CPI and PPI keep rising, higher oil prices, higher food prices, something is going to break. The stock market has to break. The bond market is already breaking. And foreign currency traders are going to have to figure out what this means to the dollar. This is not good news that foreigners are losing confidence in our creditworthiness. It's not good news. This is bad news for the dollar. And it's not bad news for gold. People should be running into gold as fast as they can. The fact that gold is pulling back in the face of this just shows, again, that traders don't understand the significance of what's going on. You go back and look at the 1980s, bond prices were collapsing and yields were soaring as gold went from $35 an ounce to $850. So gold went up with bond yields. The same thing is going to happen this time. Yes, we're having a bit of a correction before the next surge, but this is getting some people to think, hey, maybe gold isn't working as a hedge anymore, right? Just because it's pulling back. That's what these pullbacks are designed to do. They shake the conviction of the weak hands, people who really don't understand what is going on.
A pullback often scares retail right before conviction matters most. According to Peter Schiff, rising yields and weakening confidence in sovereign credit should not automatically be read as bearish for hard assets. The contradiction is that traders often treat falling gold prices as weakness, while ignoring deteriorating bond confidence beneath the surface. For wealth-preserving investors, temporary price pressure can distract from larger monetary instability. Next, Peter Schiff exposes why gold corrections can happen while systemic confidence keeps falling.
Because if you're getting out of bonds, what are you going to get into? You can't get into dollars, because the real problem with bonds is that they're IOU dollars. The reason that investors don't want to hold long-term bonds is because they don't have confidence in the long-term value of the dollar. So if you don't have confidence in the dollar and you're selling your bonds, you're not going to keep your dollars, because that's the reason you're selling your bonds. You're going to buy gold, right? Gold is what you buy when you don't want to own dollars. That is the major competitor for the dollar. It's not the euro. It's not the yen. Because again, the Europeans have their problems. The Japanese have their problems. People are going to be selling JGBs. They're selling bunds. What are they going to do with that money? They're going to do exactly what people did in the 1970s. They're going to buy gold. They're going to buy silver. So the prices that we have now are cheap. To me, gold in the 1970s went up to 200. Then it went from $35 to 200. And then it went from 200 to 100. Scared a lot of people out. And then it went from 100 to 800. So I think where we are now is in that kind of a pullback. But also, the other big difference between the 1970s and now, apart from the fact that we're in a much worse financial shape than we were back then, we were able to raise interest rates to 20%. Paul Volcker had the luxury of being able to do that because we didn't have a lot of debt at that time.
When confidence leaves bonds, cash is not automatically safety. What Peter Schiff is highlighting is the deeper issue. Sovereign debt and currency trust are tied together, so selling one can eventually pressure belief in the other. That is where precious metals become less about speculation and more about alternatives to monetary dilution. For long-term savers, ignoring that linkage can leave portfolios exposed to slow erosion, masked as stability. Next, Peter Schiff unravels why today's debt burden changes the inflation fight entirely.
Today, we can't do it. In fact, if Kevin Walsh actually tries to raise interest rates anywhere near the degree that's necessary, he can't even do it. I mean, Trump would go ballistic if the guy that he sent in to the Fed to cut rates starts jacking them up. And again, 25 basis points, 50 basis points, that's not going to do anything. We need very high interest rates. I mean, 5% won't do it. Maybe 10% won't do it. We may need interest rates as high or higher than what we had in 1980. The problem is we can't survive that. There would be massive defaults. There would be a financial crisis that would make the 2008 crisis look like a Sunday school picnic, which is why it's not going to happen, which is why this time inflation is going to run out of control. They were able to contain inflation in 1980. There is no chance that they will restrain it now. So we are going to destroy the value of the dollar. And any hope that we might do the right thing just left Congress with Thomas Massie. And as I said, and I pointed this out before, even former Secretary of the Treasury, Hank Paulson, who helped, design this whole catastrophe. He was the early architect of the bailouts and the QE. He says we need a break the glass plan to deal with the fiscal crisis that's coming when foreigners don't want to buy our bonds. Well, that's happening right now. But the interesting thing about what Hank Paulson said, or more so what he didn't say we need to do something to stop the crisis.
The real risk appears when policy tools exist on paper, but become politically or financially painful to use. Peter Schiff's argument suggests the debt load itself may limit how aggressively rates can be pushed before something wider cracks. That creates a contradiction between anti-inflation language and the actual tolerance for tightening. For investors, markets can reprice quickly when faith in policy flexibility weakens. Next, Peter Schiff reveals why crisis planning often starts after structural damage is already visible.
We should defuse the bomb before it explodes. No, nothing like that. Because I think he's resigned himself to the fact that we will do nothing to stop the crisis. And Trump kicking out Thomas Massie is more proof, because he's the guy that wanted to do something about it. He's the guy that didn't want to wait for the crisis. He wanted to be preemptive. He wanted to try to slow down the spending, to restore some sanity to Washington. And for that, they got rid of him. And so Hank Paulson knows there is no chance that we are going to avert this crisis. As far as he's concerned, we're going to have a crisis no matter what. And I agree. And so that's why he thinks we need an emergency plan to deal with the crisis. My point is, there is no plan that can deal with this crisis. It is impossible. The only thing you can do is try to prevent it. And if you're just going to resign yourself to the fact that it's inevitable, then you have to deal with the horrific consequences. There is no get out of jail free card. There is no way to do it. We're going to have to live through the worst economic period in U.S. history, and that would include the decade that we call the Great Depression. This is going to be really bad. And really what the emergency plan is how do we deal with this collapse? How do we deal with the carnage? How do we deal with the riots and the looting and the protests? I mean, when things get really, really bad to the degree that we've never seen in this country, and riots like we've never seen, because the public is going to be up in arms when they have to endure what's coming. I mean, they think it's bad now. Wait till they see what's around the corner.
Emergency language matters because institutions rarely discuss rescue plans unless stress is already being modeled. This is where Peter Schiff's thesis shifts toward prevention versus reaction, raising the harder question of whether policymakers prepare for fallout more than reform. That distinction matters because crisis management can stabilize systems without protecting purchasing power. For disciplined investors, the hidden risk is assuming official intervention automatically shields real wealth. Next, Peter Schiff exposes the contradiction between crisis planning and avoiding the policies that create it.
You know, a lot of them are the older people who Trump wants to protect. You know, one of the things that Trump said, and again, I'm not making this up, he does not want lower home prices because he wants the older people who already own homes to be able to feel rich. He said he doesn't want people who own homes and have a lot of home equity to lose that equity. He wants home prices to keep going up so that the people who bought homes a long time ago at a low price can feel good about being rich. He doesn't give a shit about the young people, young families who are struggling to buy overpriced homes. He doesn't care about them. I mean, maybe if he could find a way for them to borrow more money to afford to overpay, okay. But his number one priority are old rich people, not young working people who are struggling with inflated home prices. You know, he doesn't want prices to come down, right? So he still has the support of some of the older voters who he thinks Trump has their back. He's protecting their home equity. And he's already, you know, I'm not going to cut Social Security. I'm not going to cut Medicare. And so they love all that, you know, that he's going to preserve these big socialist programs. But when they all get wiped out to inflation, when inflation wipes out the value of their home equity, when it wipes out the purchasing power of their Social Security, of their retirement checks.
An asset that rises in price can still quietly make people poorer. As Peter Schiff points out here, the deeper contradiction is that nominal wealth like home equity or fixed retirement income can appear protected while inflation steadily strips away real purchasing power. Markets often confuse price inflation with actual prosperity, and policymakers benefit when that distinction stays blurry. For older savers especially, paper gains can mask weakening lifestyle security if essentials outpace income. Next, Peter Schiff reveals why inflation can erase protected wealth without triggering an immediate political panic.
Of their Medicare benefits, they may not look at Trump in such high regard. In the meantime, you got to pay attention to these markets. The bond market, I've always said that people said, when is the crisis going to happen? What should I look at? One was the price of gold. The other was the bond market. Gold already broke out. It's correcting, but it broke out. The bond market is breaking down. The next thing is going to be the foreign exchange market. The dollar hasn't broke down yet, but it's topping. It's very close to a breakdown. It's just a key question of when the traders can separate what's happening with nominal interest rates and what's happening with real interest rates, and the fact that the Fed is forever prohibited from really waging a successful war against inflation. Because one of the reasons I think that bonds haven't collapsed faster and that the stock market is investors still think the Fed's got it, right? They still got this under control, that inflation is not going to be too bad. And if it is, they can fix it with some rate hikes. What they don't get is the size of the rate hikes that would be required to put this genie back in the bottle are so high that it would create another crisis in the short run that would be perceived as even worse than the long-term threat of ever-rising inflation. So we won't be able to do it. Trump won't let them do it. And so you've just got to recognize this. This is a major collapse, a major realignment of the global pecking order.
Markets can look calm right before trust begins failing across multiple layers at once. Peter Schiff notes that gold, bonds, and currency pressure are not isolated signals, but often part of a broader repricing of confidence. The deeper issue is whether markets still believe central banks can contain inflation without triggering a larger credit shock. For investors protecting wealth, delayed recognition can be more damaging than volatility itself. Next, Peter Schiff exposes why rising nominal yields may still signal weakening real monetary credibility.
The dollar and the U.S. standard of living are going to collapse. It's going to be the emerging markets that are going to come out the winners. Countries like China, right, like the BRIC nations, Southeast Asia, South America, a lot of these countries are going to be the winners. The U.S., Europe, Japan could lose, but nobody will lose as much as the U.S. because nobody has as much to lose as the U.S. We have the reserve currency, not Europe, not Japan. We have been living off the reserve status of the dollar. When we lose that status, our entire economy collapses. It is not viable. It completely depends on that dollar status. Without it, we can't run these trillion-dollar trade deficits. We can't run these multi-trillion-dollar budget deficits. We can't have a service sector economy. You pull out that linchpin, and everything built on top of it comes crashing down. And the only thing that the Fed knows, the only thing the Trump administration is going to know is crank up the printing presses, spend money, more government, more inflation, and they're going to wipe it out. We don't have Ronald Reagan. We have nothing like Ronald Reagan. Trump made that clear by getting rid of Thomas Massie. He made it clear that there's no room for any Reagan Republicans in his Republican Party. He's even further to the left than Rockefeller. This is the worst Republican Party we've actually ever had. And the problem is, he's a populist. He's hitting on some of the themes. There are a lot of good Republicans who have been fooled by this charlatan. That is the problem. They think they're supporting their champion. They think he's, trying to drain the swamp. He is the swamp. The one guy in Congress that tried to drain it is the guy they got rid of, Thomas Massie.
Reserve status is often treated like permanent infrastructure, but trust-based systems can weaken before headlines admit it. According to Peter Schiff, the concern is less about a single policy error and more about dependence on monetary privilege, supporting deficits and consumption. The hidden contradiction is that nations can appear dominant while relying on confidence they do not fully control. For long-term investors, concentrated exposure to one currency story can become a quiet concentration risk. Next, Peter Schiff unravels what breaks first when monetary dominance and fiscal dependence collide.
Yeah, gold's only up about 12 bucks right now. It's just below 4,500. It was just above. I checked it a little bit ago. It was above it, so it's kind of trading above and below. Silver's back above $74. Look, this was a major breakout. You know, we did hit $89 like a week ago, so we had a big pullback. Again, the catalysts for all the sell-offs are rising bond yields and rising oil prices. Two bullish things for gold and silver. In fact, I'm looking at the 30-year yield now. This is a new high. I'm looking at 5.19%. The highest I saw during U.S. hours today was 5.18. So now we're 5.19. We should be at 5.25 very soon, before the end of the week. The 10-year is going to keep on marching up to 5%. And by the time the 10-year gets to 5%, we'll be above 5.5. We'll be closing in on 6% on the 30-year. This whole thing is imploding. And, you know, there's that old saying, how did you go broke? Well, slowly at first, then all at once. Well, we're just leaving the slowly part, and we're entering the all at once part. So you got to buckle up and get ready for this crash. But again, make sure your portfolio is ready. Not just with gold and silver. You got to get out of your U.S. stocks. You need to go to the Europac.com website and talk to my advisors or look at my mutual funds to get out of Dodge.
Sharp moves often matter less than what markets refuse to price correctly beneath them. What Peter Schiff is highlighting is the tension between rising yields, commodity strength, and investor behavior that still treats pullbacks like invalidation instead of repositioning. Institutions often watch bond stress and liquidity conditions long before retail reacts to price headlines alone. For portfolio protection, misreading volatility as resolution can leave capital exposed during repricing cycles. Next, Peter Schiff reveals why rising yields can align with stronger hard asset conviction, not weaker.
To get into the foreign stocks, the emerging markets, the gold and silver stocks, this is where money is going to be made, I think, just like it was in the 1970s. People got killed in U.S. stocks. They got killed in U.S. bonds, but they made a fortune in commodities, in gold and silver, in oil, in foreign stocks. If you saw that disaster coming and you prepared for it, you profited. This is a much bigger disaster that's going to have an even worse ending than 1980. There is no Paul Volcker coming. There is no Ronald Reagan. They've been sent packing. This is not your father's or grandfather's stagflation. It is way, way worse, and it is going to end with runaway inflation. And so you need a completely different portfolio.
History rhymes most dangerously when investors assume the next cycle will be managed like the last one. Peter Schiff's argument suggests comparisons to prior inflation eras can be useful, but blind repetition misses how debt levels, policy constraints, and global positioning have changed. The larger contradiction is that markets often expect old rescue tools, while structural conditions may no longer support them cleanly. For wealth-focused investors, diversification logic matters most when familiar assumptions fail.